Good morning, everybody. Welcome to the Profitability Playbook podcast. Today we have Alex Filippo from Merchant Factors with us. Alex is an astute business person, chartered accountant, dad to two youngsters, husband to a lovely wife, and forms part of a big community of business people within Cape Town and the broader South Africa. Alex, welcome.
Thank you. Thanks, Andrew. Wonderful to be on your show, and a huge fan of Finance Fusion. I think a great tool for all businesses. Astute businessman might be a bit of a stretch, but we try. I try, certainly.
Cool. Awesome, Alex. Maybe we can kick off with your background. First of all, I always like to ask the question like why did you study to do what you did, and how did you get into Merchant Factors and your role? Your role within the business. What does that look like?
Sure. Me in a nutshell, attended school in Cape Town, went to UCT, studied chartered accounting, very basic, very bland. Did my articles at Ernst & Young, went overseas for about a year, specialized in mergers and acquisitions and structuring of transactions. Came back here, worked at a small asset manager firm, learned all about how to analyze a company, due diligences, that sort of thing. And then ended up at Merchant Factors about 6 years ago. I'm an account executive in the company, which means I have a portfolio of clients that I look after. And it's a family-run business. My father started it 38 years ago, and it's still going strong today, touch wood. So and really enjoying the family business. Interesting dynamic. Obviously working with a founder has its challenges, but also its huge benefits. And I think there's something to be said about a wholly owned family business in today's time. Difficult to maintain and always a challenge on a daily basis.
One of my old colleagues from Varsity, he's actually a partner at KPMG in Port Elizabeth, Alan Barr. He's the national family business practitioner, and I learned a lot from him. But it's quite a science. Family business is quite a science, right? They talk about second generational, third generational family businesses that grow so much. I think is it Dis-Chem where the founder of Dis-Chem has just left the business basically to the two siblings, and I saw in the news the other day that I've actually just sold a whole bunch of shares and gone overseas. Legacy has got a lot to play in business, and it can go very wrong 2 or 3 or 4 generations down the tubes.
I don't think there is a second generation sort of person who comes into a family-run business that doesn't feel some sort of pressure. And there are various options that are available to you as a second generation person, but there's always this element of legacy that floats around in these circles that becomes an emotional attachment to it. So there is a point where the business gets too big to just be a family run entity. It's very hard to manage, and I think you need to approach it with a bit of objectivity. You need to be rational in your thinking and say, is it time to get out? Is it time to move on? Do we expand? Do we not? So never mind the fact that you're actually trying to run a business in, the general sense. There's also all these existential sort of large strategic decisions in the background that need to happen. Makes it complicated.
Yeah, I can imagine. I mean, like coming in with a founder, let's say a founder above you, with that founder having his or her own ideas about the business, their own ideologies, their own upbringing, which is not the same as yours, and then somebody else, you coming in or whoever else coming in, having different ideas, obviously respecting that founder for who they are and what they've achieved, but your ideas might be different. Again,
you're hitting the nail on the head. It's one of those situations where you've got a founder that came from nothing, the business from essentially zero, and had everything to lose and no fallback position, and has built a very successful, thriving empire. It's automatically very, very different to someone who's coming in at second generation and has all of these ideas, exposure to the world, the outside world, and wanting to bring ideas into the business. Slow to change, I would say. I've got a phrase that I coined at an asset manager called slowly a ship.
Yeah.
So think of a cruise ship. They don't operate very quickly. They move slowly, and it's one of those situations that you need to be aware of who you're dealing with. The family dynamics become very important.
Cool, man. Thanks, Alex. So tell me a bit about your clients. Who are your clients? Why do they come to you? What do you do for them? And in terms of what is Merchant Factors? I mean, I know I've done a bit of work for you guys, and I was very intrigued as to what you actually do. You're actually offering a really solid, ethical, professional service to your clients. And how do you get that across to new clients? I mean, first of all, who are your clients? What do you do for them, and why do they come to you?
Okay, great. It's a great question. So our clients are the SME market. So again, that's quite a broad term, but let's call it a company doing anywhere from R1 million a month all the way up to 50 million rand a month in turnover. That's our target market. And generally it is business to business. So a company that sells bottles to Pick n Pay, for example, that level of suppliers to Pick n Pays, to the major retailers, to the mines, to whatever you call it, steel companies, that would be our target market. And what we do, in a sense, is we've got two products: invoice discounting, but not in the traditional sense of invoice discounting. So it's disclosed facilities. In other words, we would contact Pick n Pay, for example, and let them know of our existence. The traditional form of invoice discounting, which banks do, is undisclosed. So the end customer, like Pick n Pay, would not know that their supplier is discounting their book. But with us, it's fully disclosed. So that's the one product. And then on the other side, we have working capital loans, bridging finance, trade finance, which is more a type of a term loan facility, or like an overdraft, if you want to picture it like that, like the banks do. And effectively, we borrow from a corporate bank, and we then on lend or finance other companies. And we've been doing it for a long time. Principal product is factoring, and it's very niche. And in this South African market, not many people understand it or know of it, which has been our greatest challenge and our competitive advantage, if you will, because it's almost the space that once it's educated on the product, then they see the value and the benefit. So not every Tom, Dick, and Harry is able to do what we do, for example.
Sure.
And it's got a negative perception in the market because it's seen as expensive, but it's actually not. And I can always delve into detail at another date, another time, of how you can prove that factoring is really actually quite a cheap product. The working capital loans on the other side are expensive because our money is not lent out at prime like a bank would. So that's expensive, but generally it's for a short period of time. You're not going to borrow over 5 years from us. You're going to borrow for 3 months to bridge a property transaction or bring in stock or whatever the case may be. Yeah.
I think you're not just giving finance. You're giving a service. I mean, and Alex, why do these guys come to you? Why do the suppliers of Pick n Pay come to Merchant Factors?
It's a good question. And we're targeting Pick n Pay here, which might be a little bit unfair. Any major corporation that has suppliers is going to do what's best for their company. So they are going to try and stretch the terms of sale as far as possible. 90 days from statement, or from invoice, for example, 60 days. Yeah. And what ends up happening is that these suppliers are under a lot of pressure to service these big companies because they want the big contracts. So they would come to us to look to bridge the gap between raising that invoice and delivering your product to actually getting paid. That lag is where we fit in. So whether you're growing as a SME or you are just sitting still, cash is king. There was a good guy who actually coined the phrase, well, didn't coin the phrase, but expanded on the phrase, a guy by the name of Grant Cardone. He actually said that revenue is vanity, profit is sanity, and cash flow is king.
Yeah.
So we're effectively that cash flow gap for you. And that's where, you know, we talk about the costings and things like that. It all comes out in the wash. But to answer your question in short, SMEs need us to bridge that cash flow gap.
Sure. And I mean, it's not that SMEs are doing anything wrong, that they need to go and get loans or factor their invoicing. It's because of the terms they have got with the big guys.
Correct. So, just to expand on that point, Andrew, I mean, as I said, in this country, it's not a very well-known product. In the States and the UK and everywhere in Europe, invoice factoring or invoice discounting is a very, very common tool. Almost every single company uses it because it's like I said, with that negative perception right in the beginning. You're factoring your book. Why? Are you in trouble? No, you're not in trouble. It's actually a better way to service your customers by allowing them those extended terms. Say, don't worry about it. Pay me in 90 days. It's absolutely fine, and I will ensure that the consistency of your supply is there. You can only do that with a consistent cash flow supply. So it's not about being in trouble or you know, those sorts of things. It's actually just about the appropriate management and projection of your cash flow.
And it's not just cash flow you're giving them. I mean, you're freeing up their cash flow so they can do business and they can expand their business. But at the same time, you're also offering them a service, so they're not having to do it themselves. So you're giving them cash flow capacity and people capacity. So, you know, killing two birds with one stone.
Correct.
Alex, let's talk about the big banks. Let's talk about what are these micro lenders? There's so many different ones these days. I'm not even going to mention their names. These micro financing. I mean, why do people come to you and not to the big bank or other financiers?
It's a good question. So typically our clients don't fit the tick box exercise. So banks, you get the banks on the one side and the micro lenders on the other. There's a vast big gap of space between the two, in terms of pricing, in terms of controls, in terms of criteria. Now we fit more along the bank side, less towards the micro lenders, because we are still structured and you know, we do take security and that sort of thing. But a typical client might be showing a little bit of red ink. You know, it was a hard month. We had to move premises and we've got this and that, and banks don't always understand that. They might be, you know, doing a capital expansion and need to put working capital into that, and the banks look at it and say, but what's happening with your trading? Why are you not buying more stock? And we look through that sort of thing, through the client's balance sheet to their debtors, because that is our principal security. So we would look at the strength of the debtors book, i.e. the Pick n Pays, the Woolworths, how spread is it? Sure, you might not have the big retailers, but you've got 100 smaller guys that pay on the button, no issues, and that's where the strength comes in. So the bank places less emphasis on the debtors because they don't know how to control them. They don't have the facility, they don't have the wherewithal, but we have the ability to look through any losses. I'm not saying everything, but one-offs, you know, if it can be explained and shown why, the reasons for that, we would assist. And where, as a bank, you know, and as an SME, the banks don't really communicate very well to their SMEs. And we understand the challenges that the SME faces. You know, I've got an example of a client that left an invoice in their drawer, for example, instead of actually adding it to the statement and sending it out, so that they got the payment at the end of the month was a problem. So we understand all of those problems, and that's why in our credit control function, which is the full factoring model that we do, we take care of that as your credit control back office and assist you with all of those administrative type of things. And an admin issue can be the reason why a bank says no to you.
Yeah, totally. I've just been through the process of about 6 or 9 months ago, I'm a fractional CFO for an engineering client, and we were looking for a bigger bank overdraft, and we went to the current bank that we deal with, that we've been dealing with for 10 years, and they gave us an absolute piddly overdraft. It was terrible. Then we went to the bank that I bank with, personally, that I banked with for like 20 years. I think you may have banked with them as well. It starts with an I, Investec. And they offered the guys like 10 times what their current bank is offering.
Yeah.
Yes, banks go through their phases of like acquiring businesses and their different risk phases and their risk appetites, but I just found that absolutely incredible. So, Alex, another question. So, have you ever lost a client, right? Because you've done such a good job.
A good question. Actually, it does happen. So, typically our facilities, they run for 12 months. And usually what ends up happening is a client will come to us and say, look, I'm almost there at a point of where I need to be able to have a banking overdraft or a larger invoice discounting facility. You know, after this year, I won't really need any major cash flow assistance. I should be cash flush. We have that often.
Yeah.
But what ends up happening is the clients end up staying because of the service that we provide. So even though they don't need the cash flow,
sure,
they use our admin services, which is something else that we offer.
Peace of mind.
Yeah, and it's a non-cash flow product. So you get the use of our system, credit controller, the whole shebang for a fixed fee per month based on a number of variables. And you get to use that if, for example, whether you need the cash flow or not.
Yeah.
So some guys, they could easily move to a bank, but they don't want to because they know they can pick up the phone, get me on a Friday afternoon, for example, and say, listen, I've got a problem. Or, what do you think of this? There's a liquidation here. Should I buy a property? Blah, blah, blah. So there's a whole lot of extra services that we offer, advice, that sort of thing, that they don't get at a bank, and they can't pick up the phone and ask anybody.
Yeah.
Never mind the banking aspect. We've got the legal side as well, where because of our experience, we tend to have a lot more wherewithal with regards to the legal process. So property law, insolvency, all of those sorts of things that A, the bank doesn't have, and B, the lawyer might not even have. So there's a lot of added benefit with regards to that and how we assist our clients. So generally, yes, they are often in a position to leave, but they don't because they enjoy the service, they're used to it, and they just end up staying. It does happen though. There are clients that leave, and you find that the return rate is also actually quite high.
Yeah.
So they might go to a big bank for an invoice discounting facility, not be able to deal with the call center that they have there, not being able to pick up a phone and speak to somebody. They come back.
Yeah. Are you able to help me to close my Discovery bank account that I opened 10 years ago to get a free Apple Watch?
Oh man, if I've heard that story, I don't know how many times. I actually have the same problem. And what I've sort of done is I've just paid it off over time, and now I'm at a position where I don't need it anymore, and I can just close it because I never needed it in the first place. I don't know why I did it. I did it, but now I'm locked into this thing, and I'm trying to close the damn account, and they're charging me bank fees every month. So it's costing me good marketing. Good marketing.
Yes, it's crazy. So, Alex, I know you probably don't know too much about the actual mechanisms that your clients go through in terms of finance and the understanding of their financial literacy themselves. But do you have anything in terms of like the clients that you deal with and their financial literacy? Do you find that it's a problem? Do you find that they generally have a grip on it?
So typically, if I can just, it's again a great question. I think, and I was, we're also hosting a podcast, sort of that hasn't officially launched yet, but will soon launch, where we deal with all of these cash flow questions. Typically, our clients, it's an owner-run business. The owner is trying to do everything.
Yeah.
might be very good at sales and understand his product, but doesn't have the financial acumen to deal with the important aspects that go with running a business.
Yeah.
So immediately we get involved and we look and we say, look, this is a problem, here you can fix this, let us assist you here. But the main thing for me is that I think business owners, everyone understands how to do a profit and loss income statement, right? Income, expenses, bang. But no one really understands, well, a lot of people don't really understand the importance of a cash flow projection.
Yes.
So, and this is where all businesses seem to fall short. And it's something that I spoke about for quite a while in our podcast last week. Do a profit projection for your business, but do a combined cash flow projection right underneath it as well, and project forward for the next 3 to 6 months.
Yeah.
Immediately, it answers the questions: what am I going to need at month end? What am I going to need in 2 months' time? How am I going to fill this order? How am I going to fill that order? And it will. It's one of the most useful tools that I would ascribe, or prescribe to a young SME business that's owner managed. So yeah, I don't know if that answers your question, but
absolutely, Alex. I mean, you're speaking my language now, and I think I see entrepreneurs every day. I see micro entrepreneurs. I see SME entrepreneurs, and I have a client, a recurring client that's also an SME client, and I mean they're doing millions. I mean they're doing 100 million plus, and the one thing that the owner loved about what I did, the first thing I did was exactly that. I sat with the accountant. I said, okay, we're looking in the rearview mirror every month, right? We're looking to see what was our revenue last month, what was our cost of sales, what was our OPEX, what was our profit last month, and how much money do you have in the bank now? But we don't know how much money we're going to have in the bank at the end of Feb. We need to pay provisional tax. We've got all these commitments that we need to make. We might need to pay bonuses. We don't know where we are. And as soon as you do what you've said, I think what it does is now you know that for the next 9 months, this is your profit every month. This is your revenue every month. This is where your cash flow will end every month. And you can straight away see where the stress points are in terms of, I need to get more business for July, or I need to reduce costs in September, or I need to maybe raise some finance in October. But it gives the owner clarity, doesn't it? It gives them that peace of mind and that clarity.
It is such a forgotten thing, actually, and such a useful tool to use. And it's one of the first things that we ask for before we approve the facilities. We want to see for the next 12 months what this business is going to look like. And then we rephrase it and say, okay, what is the cash position of this business for the next 12 months? And immediately, as soon as you ask that question, it starts getting them to think about, wow, okay, we haven't thought about how we're going to do this, how we're going to do that. You can't buy anything with profit.
No, it's very true.
You only buy stuff with cash. So
I love that.
And it's something that's always stuck with me, is that you get these immensely profitable businesses that are doing these massive turnovers but have got no cash.
And Alex, so many entrepreneurs I chat to, they're operating like we always say, like a hairdresser. They're living out the till. Money goes in the till, money goes out the till or out the drawer. And some of them might be lucky enough to have an income statement to say, this is how much profit I made every month. But I'll never forget the question I got from one of my clients. He said, Andrew, he says, we've made like so many million net profit this year, but why don't we have any money in the bank? Yeah. And I literally had to explain to him the relationship between the income statement and the balance sheet. So, we've made all this profit, but we don't have enough cash in the bank, but we do have cash that is owed to us by our customers. Correct. So we have assets. So that profit has created an asset which isn't cash, it's obviously accounts receivable. And we're not doing the right job to actually follow through on collecting that cash. And obviously that's where merchant factors comes in as well.
So we like to actually, to your point, we like to think about it like this. I mean, you can sell or seed any asset, anything, right? Yeah. That's an asset. And your debtors book is one of the largest assets on your balance sheet usually.
Yeah.
And it's your money that's sitting there, that's not earning interest, that's hampering your business. So it's such a useful tool to leverage off, and people don't understand.
Yeah. No, it's very true. It's very true. Alex, I think in wrapping up, it might not be relating to what you do, but I mean, what is the one thing that you think businesses could do to immediately improve their cash position? Other than obviously coming to you guys, what else do you think, what other options are there for businesses?
So, I mean, if you are looking at loans and things like that, there's the options are endless. I mean, there's guys that take unsecured loans, there's guys that have secured loans, but I think the most useful tool to protect a company's cash flow is something that I learned from a very young age, which is called proper planning prevents poor performance. That is the 5P principle that I think every single owner should have in their back pocket.
Yeah.
You need to understand your cash flow and how your cash in your business works. That's the easiest way and the most foolproof way to improve the cash flow of your business. Yeah. So before you end up in a situation at the month end where you don't have money to pay salaries and wages and whatever else, debit orders, take 3 steps back and plan it today. Yeah. Sit down and say, daily, weekly, monthly, these are my cash flow requirements. This is how many sales I have to make. This is when the money's going to flow in. What do I need to do to bridge that gap?
I think some people that they think it's so complex and confusing, but it's actually so not. They just need somebody, I think, sometimes just to hold their hand, just to show them this is what it looks like, and to simplify it. 100%. No, thanks, Alex.
Happy to do that anytime with anybody.
Yeah,
if they need some advice, phone call, we're available.
Sure. Alex, thank you so much. Thank you so much for being a guest. Any shout outs that you would like to make? Maybe you want to tell us about your podcast.
Well, first of all, I'd like to shout out to my entire Merchant Factors family. We're bordering on the 60 mark in terms of number of people. Offices in Joburg and Durban, they work very hard. And our head office down here in Cape Town, the guys are running around like headless chickens trying to make our clients happy. And we appreciate that very much. Yeah, our podcast is, like I said, not live yet. It will be on our website and free for anybody that wants to listen. Talking about issues like we discussed today, useful set of tools for business owners, that sort of thing, to brave the cash flow storm. And I mean, now more than ever, with petrol going up, diesel going up, almost disappearing, it's good to have cash reserves, and happy to help and assist wherever. So that's it. And thanks for having me on the show. Really lovely to catch up, and always here if there's anything you need.
Alex, thank you so much. Thank you so much.
Andrew.